ETFs are an investment vehicle that provides diversity, flexibility, and low fees. Count me in. My name is John Ross with Finance on a Budget. In this video, I will take you through the top 7 reasons why ETFs can be a great investment vehicle for your portfolio. As a quick refresher, an ETF or exchange-traded fund is essentially the type of security that can be bought and sold just like regular stock. The kicker is that it is made up of a collection of pre-selected stocks, bonds, and commodities. So instead of just buying into one company, by investing in an ETF, you are buying into a mini portfolio of partial shares in a number of different companies. This can help in diversifying your assets, minimizing your risk, and lowering your overall costs. Portfolio diversification and risk management. Let's begin with benefit number 1. Portfolio diversification. When it comes to investing, the old adage rings true. You should never put all of your eggs into one basket. But then, where should you put all of your eggs? Stocks, bonds, commodities, currencies, crypto, the types of securities that you can invest in are endless. Not to mention there are different sectors, industries, and different markets. This dizzying array of choices can leave any investor feeling overwhelmed as they try and balance a well-rounded portfolio. You could use an actual broker who actively manages the funds, but they come with high management fees, a number of service fees, sales and distribution costs, and other expenses. By contrast, ETFs offer a passive fund management, which means more money is saved and back in your pocket. This is where ETFs truly shine. Investors can quickly gain easy exposure to a range of different market segments or different companies within a specific market segment. For example, if you think that the biotech sector is going to boom in the next few years, but you're not sure which company to back, why not invest in a biotech ETF and cover all of your bases? Or, if you're not really set on any specific sector and all you care about is growth, why not invest in an ETF that focuses on the fastest growing stocks? By investing in ETF shares, you're simply spreading your risk around. This way, if one company underperforms or suddenly goes belly up, you have other interests to counteract it. With ETFs, you can easily balance your risk with a diversified portfolio. Lower fees. Instead of placing multiple orders for different companies, when you invest in an ETF, you only need to enter into one single transaction. Not only does this simplify the purchasing process, it also lowers your fees and commissions. In the long run, it also streamlines operation costs such as monthly statements, notifications, and transfers that are no longer required. An ETF does charge a yearly fee. However, think about these fees as your payment to the ETF portfolio managers. They're the ones doing all of the thinking. They're the ones choosing the best assets, instead of you doing all the work like researching stock, reading financial statements, and doing technical analysis. You could just sit back, relax, and let them do all the work. The average fee is usually less than 1% anyway, so why bother with all that work? According to Investopia in 2021, the average annual fee for a passively traded ETF is 0.13%. For actively traded ETFs, it's 0.66%. Not bad, right? What's more intriguing is that some of the online firms charge $0 for an unlimited number of trades made to your ETFs. For every $1,000 you invest in an actively traded ETF, you only pay $6.60 once per year. Imagine that. Would you rather pay a professional portfolio manager who has several degrees and years of experience for $6.60, or do you want to do it all yourself? The choice is a no-brainer. Save yourself the time and focus on more important things in life. Trading flexibility. Just like regular stocks, ETFs are bought and sold during the day throughout market hours. There are no lock-ins or maturity periods where liquidity is generally high. This means that investors can easily get in and out of investments as quickly as they please, while staying on top of market trends. With mutual funds, you can't do this. You can't trade them in real time like ETFs. That's what makes ETFs kind of like stocks, but with the benefit of being a bundle of assets like mutual funds. Want to switch between ETFs because you think one would be more profitable? Easy. Just sell your current ETF and invest in the new one. Is the market being bearish and bringing down the profits with you? Easy. Just sell your ETF like you would sell a stock. With ETFs, you get the flexibility of trading with asset diversification that you won't get on any other financial product. Investment management. With ETFs, it doesn't matter. You can be hands-on and select different sectors, or you can simply mimic a market index. The choice is yours. Manage your investments in either style or something in between. Passively traded ETFs are fit for investors who prefer a buy and hold strategy. Take note, being passive is not a negative term. It's a valid strategy, and most of the time they even perform better than their actively traded counterpart, especially when the market is unstable. Actively traded ETFs are for investors that are not content with average returns. They want profits and they want it now. They're for the ones who want to play the high-risk, high-reward game. If you're the relaxed, chill, take it as it comes type of investor, go with passive. But if you're a go-getter, no pain, no gain, just do it type, then an active ETF might be best for you. Whichever of these two types of ETFs you choose, you're still a winner. Historical performances show that both of these strategies have a positive return in the long run. As long as there's no catastrophic event that will shake the markets in the future, like a global recession, then you can rest easy knowing that you've invested in the right product. Accountability. The financial entities behind actively traded ETFs are required to publish a list of the assets in the fund daily. This keeps you up to date with the assets that you hold, and it keeps the financial entities accountable to you. Other investment vehicles don't have this requirement. Having accountability gives retail investors like us the power to choose which ETFs agree with us the most in our investing strategy. You wouldn't want to give someone your hard-earned money for investing without knowing what they're going to do with it, right? For example, if you own shares in the SPY ETF, the oldest and most recognized ETF in the United States, you can go to sites like Yahoo Finance, MarketWatch, or ETF.com and find the saying holdings and check out what's inside that ETF. For SPY, you will see that their top 3 stock holdings are Apple with 5.76%, Microsoft with 5.30%, and Amazon with 3.98%. These values change every day. The fund managers might decide one day to invest more in energy stocks than technology stocks, and it will let you know. It's there for everyone to see. That's one of the beauties of ETF stocks. Immediate dividends. Unlike many mutual funds that distribute dividends annually, most ETFs will drop dividend payments into your brokerage account every quarter, if not every month. Monthly payments instead of yearly? Yes, thank you. This is possible if you invest in ETFs that own dividend-paying stocks. You have to go to a financial website, find out which dividend-paying stocks you want, then find ETFs that hold those stocks and invest in that ETF. Alternatively, you can just search for dividend-paying ETFs, check out their terms and yields, and find out how much you can invest in them. Easy, right? I have another video pointing out my own top ETFs, linked below. But even then, I'm missing out on QYLD, which holds a yield of 12.35%, which is crazy. Go where the money is, boys and girls. Simplicity. Benefit number 7 is simplicity. ETFs are simple structures that are easy to understand and offer excellent value for investors. This simplicity has led to an outstanding pace of growth. In the United States, ETFs currently account for about 40% of all the assets under management. In Japan, this figure is closer to 70% and is only expected to rise even further. You see, more and more investors choose the simplicity of ETFs. It's a chore tracking 10 stocks at once. There's a lot of graphs, a lot of numbers, a lot of news reading, and a lot of market timing. With ETFs, life is simpler. It's only one graph. Let the professionals do the work. They know the market way better than you do. Trust the process. With diversification, low fees, flexibility, different investing styles, accountability, quarterly dividends, and simplicity, ETFs are one of the soundest investment vehicles around. I really hope you found this video useful and it has sparked an interest in exchange-traded funds. If you're now convinced that ETFs should form some part of your investment portfolio, check out my video at the link down below that will show my picks for the best 5 ETFs to buy and hold. Be sure to give this video a like, subscribe, and if you found it informative, please leave a comment and enable the notification bell. Thanks for watching.